what I'm seeing is a move away from safes, certainly uncapped safes, and more to convertible notes that are liabilities on the balance sheet. Convertible notes are better for investors because you have some rights. And I think you're going to see less safes done this year in pre-seed and more convertible notes. I'm also seeing seed rounds turning from safe notes into priced rounds. I think the seed and Series A's are certainly priced, but I'm seeing seeds becoming more priced now than in safe notes. And I think that's a good thing. I think clean cap tables are the ones that get funded. We went public on March 17th. The peak of the NASDAQ was March 21st. We were the absolute last company to go public in the dot-com boom. And then it started to go down after that. And, by the time the lockup came off, we were down about 40 to 50%.
Hello, and welcome to Fireside with the VC. My name is Andrew Romans, and we're here today with Martin Tobias from Incisive Ventures. And this is an emerging manager, venture capitalist, but a mature guy who's been around. So if you've ever been frustrated with dealing with a freshly minted MBA, making big decisions, giving you huge feedback on an industry you understand, it'll be refreshing if you ever deal with Martin, because he's been around for a while. He's ex-Microsoft. Let me quickly get into his bio here. Martin is the founder of Operator VC Incisive Ventures. He's ex-Accenture, Microsoft, former venture partner at Ignition Partners, who I think is easily 2 billion AUM. Martin is a 3-time venture-funded CEO, raised over $500 million himself, and achieved 2 IPOs. He's also invested personally in over 200 companies as an angel, 50 of which I believe have gone through the vehicle Incisive Ventures, which I think is his fund one, but we'll get into all of this. And some of his angel investments, when someone says, have you invested in anything that I've ever heard of? He can tell you that he invested in Google, DocuSign, OpenSea, and dozens of unicorns. So before we jump into this episode, a quick word from my buddy Mark Titirjani talking about venture debt.
Hi, everybody. This is Mark Titirjani. I'm with Pacific Western Bank, and we are a bank focused on helping startups grow and get to the next stage. We've been working with Andrew and 7BC for years now. Andrew and I go back a decade and a half at this point, and I've always respected the fact that he's a thought leader in the space and somebody that you can learn an awful lot. And he kind of opens up that window a little bit into VC and what's happening in the back room. So we're excited to be partnered with Andrew on his podcast here at Pacific Western Bank. We focus on helping startups get to the next level. We offer a startup services program for companies that are the pre-A, which includes some free banking and some high yield interest rates. And then when companies raise an A round, then we start moving into treasury management services and then venture debt. And we believe that we're one of the leaders in the venture debt market because we are flexible and we can do custom packages and we don't just do off the shelf type of term sheets. So enjoy the podcast. It's going to be a lot of fun. You're going to learn some things and we'll see you on the other side.
Thanks, Mark. And anybody who needs an introduction, happy to share your information with them. Just get in touch with me and I'll put you in touch with Mark. Thanks so much for supporting and sponsoring the pod. Okay, Martin, great to see you.
Hi, thanks for having me, Andrew. Good to talk.
This is part of our deeper dive into the Seattle ecosystem. We've identified Seattle as like a key market for us. And so we're up there every couple of months doing events and talking to all the VCs. Before we get into Incisive and your background, Martin, explain how the Seattle ecosystem is different from Silicon Valley or even other emerging markets like Austin, LA, New York. What makes Seattle different?
Well, it rains a lot and we have snow. We were just talking about that before the show. I don't know. When I was at Microsoft and when I got my first company funded, which was Laudai Technologies, there were basically about 3 or 4 VCs in Seattle. There was the original one was one called Olympic Venture Partners, OVP. They're not around anymore.
What years are we talking?
That
90s
that
or
would have been in the early 90s. So
right?
sort of 93, 94, 95
Okay.
type. And you know, the names you hear now weren't even there. Madrona Ventures and Mavron. But right now it's a very big ecosystem, and it's a lot of homegrown people who had left Microsoft, people who were ex Amazon, things like that. A lot of entrepreneurs, a lot of solo VCs. So you don't have, obviously people from the Valley do come up there, but there is a homegrown ecosystem up there that has come out of the companies that have been successful, like Amazon and Microsoft, which I think is a little bit different.
Yeah. I mean, I remember in the mid 90s to late 90s, Paul Allen's Vulcan. In fact, I remember pretty clearly his website would say, send us your business plan. And that was back when you had a 55-page business plan and overhead projector, Kinko's printouts that are changing, which is annoying. But it said on submit your business plan to Vulcan, Paul Allen's VC, and you automatically like sign some kind of reverse NDA that any information you share, they can do anything with it they want, or something crazy like that. But I think of Vulcan as one of the original powerhouse investors in startups of the area. Is that not true?
It's true, but you know, I wouldn't have, back then I wouldn't have considered Vulcan a VC at the time. Vulcan was a private, he was like a super angel, right? Because it was all balance sheet stuff. The guy who was running, he hired a guy named Steve Hall out of New York to come to Seattle and run his venture arm. And Steve's a friend of mine. He's now retired from Vulcan. But he definitely was out there writing checks, but it wasn't a traditional VC model with you know, a bunch of associates and help and stuff. Like it was Steve Hall and Paul Allen. And basically if Paul liked your thing, he would write a check. And he was definitely formative of getting a couple of companies going there, and they've done very well. But it's more like a family office, because he would invest. He's also one of the largest landowners. He owns most of the buildings that Amazon is in, and his primary investment is actually real estate in Seattle. And so it was a multi-strategy office. They were doing M&A, they were doing venture, and venture was frankly the smallest allocation in their family office. So I think there was a different level of focus there. But he had a labs thing before that was cool, you know, where EIRs were in there. He was probably the first in Seattle to do that. Vulcan was. But I, you know, it wasn't the traditional LP. It was a single LP office.
Right. I know a guy, maybe better not to say the name, because he told me like specific numbers of how much money he invested while at Vulcan, what the returns were on his investment, which wasn't bad, and said that there was no 2 and 20. It was a salary and a bonus that was barely tied to performance. So it was like, it sounded a bit like being shackled at a CVC or something, but it's a family office. I mean, you know, co-founder of Microsoft, he's got money, obviously.
Yes. It was not the traditional venture model with LPs and carry for managers and stuff like that.
Yeah. Well,
but it was certainly a very interesting and important source of capital for entrepreneurs.
Sure.
And has been. I think it's set up more as a regular LP with all of those things now that they've spun out of Vulcan, and they're kind of disaggregating all of the Vulcan things after Paul's death.
Okay. Well, so tell me about, you know, roughly what were the years at Microsoft, and what was the timing of these two startups? $500 million is a lot of money to raise. Is that maybe how much of that was venture, or is that part of the issuance of the initial public offering?
That included the IPO and debt and stuff like that. And so, you know, I came, I worked for Anderson Consulting right out of college from 89 to approximately, well, no, was that 89? I might even have to look at LinkedIn, to 92 or something like that. And then I was at Microsoft from 92 to until about 97. And I started Loud Eye Technologies in 97. And I left Microsoft on a Friday. I had my first customer meeting on a Monday. Wow. And I got funded like 3 days later.
Yeah, 97 was a good year to raise venture capital.
Yeah.
It's probably a good vintage to be in venture capital.
It was a very good vintage to be in venture capital. And also, when I look back on it, that was the old way of doing things for raise sizes and stuff like. So we didn't do an angel, a pre-seed, a seed, and a Series A. We went straight to the Series A.
Yeah,
and
because by the way, because you needed it. You probably had. I did the same thing. We needed a $50,000 Sun Spark. We needed an Oracle license that was crazy, and so the cost of actually you're your own node with your own IP address on the internet. Like every startup is part of the internet. It's crazy.
It was very expensive. I was doing something on my blog one time back then, which was interesting. I was tracking the cost per terabyte of disk storage and how it was going down following Moore's law. When I started the company, the cost per terabyte was $100,000.
Oh my gosh!
Terabyte, right?
Yeah, that's the storage on my Mac right now, my laptop.
Exactly. It was $100,000, and we were doing creating a digital media library, putting digital copies of music on a big server. So we needed a ton of it. I think we bought like 300 terabytes. But anyway, my first round was a Series A, and it was 5 on 10.
Right. Which, by the way, I missed the days of like the pre-money valuation is twice the round because that's 33% dilution.
33% dilution.
So whatever the number is of the round, you double it. You got your
33% dilution.
Now you got to use like an extra brain cell to get there. That's funny. Yeah, my first real funding round was 15 on 30 with 3 tranches of the drawdown. Yeah. Which was a little hairy compared to the way things work now.
Yeah, but that was that. So that was my first round. But I got for that, that was led by Olympic Venture Partners, which at the time was the oldest and most senior firm in town. And the guys had been doing it forever. They coached tons of entrepreneurs. And we got weekly calls with it's old school VC where they're actually helping you figure out how to be an entrepreneur. Coming out of a big company, because I was coming out of Microsoft, and it was really great. Lots of hands-on. It wasn't one of these get assigned an MBA at a college and he just asks you for financials every month at a board meeting. It was very, very hands-on, very, very helpful. So I raised that, and then we went public in March of 2000. So that was 3 years from first funding to IPO. And, that's an incredibly short, that was a time when the IPO window was wide open and things were completely compressed. And, that was a really fast way to grow a company. We went from founding to, we had about 400 employees and $10 million of revenue. And we went public for a $2 billion market cap with $10 million.
Jesus. I mean, yeah. I remember multiples like, this company is valued at 4x top line sales to 12x, depending on this. The multiples back then sounded like years. The multiple is 1848, is the multiple of revenue to enterprise value or pre-money, market cap, whatever. That's crazy.
No, we went public at 200x revenue.
200x. But by the way, if you went out in early 2000, what was the lockup for you?
6 months.
Oh, 6 months. Okay, yeah. So 6 months. The real nightmare was like March of 2001. I think was the total demise. When was
March of 2000. We went public on March 17th. The peak of the Nasdaq was March 21st. We were the absolute last company to go public in the .com boom, and then it started to go down after that. And by the time the lockup came off, we were down about 40 to 50%, and it ended up where the company, all of those companies ended up going down 90-95%.
Right.
So but I was completely fine, but the lesson I took from that was that timing does matter. And you're not able to pick the market, whether it's good or bad, that you raise financing in. And CEOs need to raise financing when they can. If I had waited even 5 days on my IPO, we would not have been a public company. And in fact, that same thing happened to the second company that I was CEO of when we went public. It was Imperium Renewables. That was a biodiesel company that I founded or I invested in and became CEO, and then took public. But we were going public in 2008, and we went on file. We chose the investment bankers between Goldman and Morgan and Lehman in February of 2008. It took us a little longer to get through the SEC. We were ready in November of 2008, and the IPO window was still open, but things had started to degrade a little bit at the end of 2008. And we were on a pricing call with Morgan, the lead banker, and they said, "Do you want to go?" We had the G5, we had everything set up for the road show. We even had a pre-booked amount of meetings and orders. And a few of the investors said, "Well, we think the market's kind of come down a little bit," because when they pitched us in the bake-off, they said it's going to be a $1.2 billion valuation, and they said pricing guidance at the pricing call is 800 million. And some investors said, we want to have a B, and so let's wait a quarter. And I said, "You're stupid to wait a quarter. This is not going to get better. We have to go." I was outvoted, and the IPO window closed like 2 weeks later.
Yeah.
With a slam.
I mean, my experience, I was intimately on that same path. We had a $1.2 billion valuation with Morgan Stanley, a $50 million pre-IPO financing from Morgan Stanley Dean Witter, private equity out of New York. And it was just so minute to minute. And I remember FBR, Friedman's Billing and Ramsey, was this small investment bank that was doing deals. And I was, a Georgetown University guy. So this is Northern Virginia in the DC ecosystem, which was very hot. There's a lot of big IPOs that happen there, AOL and all that. And I remember my CFO saying, "I'm not going to go with anybody but Goldman Sachs, Morgan Stanley, or JP Morgan. That is it." And he was ex-AT&T. He was took their 54-year-old early retirement. So the guy's got zero risk. Right. And for me, it was $500 million fluctuations personally. Right. And I was like, if we had just gone out with FBR, we would have easily have raised 90. You think about it as a VC, not a startup, not running out of cash. We would have raised 90 million minimum. Instead, greed and pride and brand and snobbery, led to this, Morgan Stanley relationship. And then the lockup for us was 18 months. So it was not a good outcome. Yeah. The true learning is like a bird in the hand. Real money is there. Don't be saying no unless you really can afford to not do it.
Yeah. I think you and I have been through a couple of these cycles and understand that things can change quite quickly, and that, the bird in the hand thing. I think that's incredibly valuable in the environment that we're in now. And many new investors and founders who haven't been through those kinds of things don't understand that. And back then also, a lot of people were thinking, or even today, I've talked to founders who think the IPO is the exit, and the IPO is simply another way to finance your company and to raise money and to continue to operate. It is in many ways a more expensive one and comes with some other, responsibilities with reporting and stuff like that. But it's not an exit, certainly not for the founders. If you have a lockup and things like that, or even the employees, there's trading windows, there's all sorts of problems getting your money out eventually. So you need to think of it as a financing opportunity. And, if you need to do it, you need to do it. That's exactly what happened with Imperium Renewables. They missed the window, and then the board told me to go and try to find private investors. And I said, do you think the private market's going to be better than the public market?
Yeah, right.
It's just not gonna happen. And they ended up recapping the company 6 months later at a 50 pre, and we had an $800 million valuation at the IPO. So
right. What was the right decision to be doing there? So when did you start angel investing? I mean, I remember when I had raised 15 on 30, and I'm on stage at events all over the world, everybody's asking you, can you put in even $10,000 in my startup?
Yeah.
What was or were you investing out of Microsoft? What was your birth of your angel career?
I started investing in the early 90s when I was at Microsoft. And the reason I started is because I was working in a group called Channel Policies, and we were working in the early days of a program Microsoft called Electronic Software Distribution, which was the beginning of how to do electronic licensing to the enterprise, where the client checks with a server for a license key. You probably remember back in the day, software licensing used to be paper-based, and these holograms, and you had to have these pieces of paper where you type in this number.
Yeah, I probably still have them in my closet somewhere.
Yeah, probably. So, but and I was developing the infrastructure for the enterprise, because what enterprise customers were saying is, hey, we don't want 10,000 boxes of Windows. We just want to be able to download the Windows from a server, have licenses be verified. Can you just simplify our operations, right? And now, of course, all software is done like that, but I designed the system for that. And anyway, I was working with Microsoft with a bunch of software companies that were early in digital rights management around software and this whole key passing things and encryption and all of this stuff.
DRM.
DRM. And I was doing deals with them from Microsoft. And one of the things I noticed is that these guys doing startups were having a lot of fun. And I was like, hey, maybe I could invest in some of these companies, especially because I'm giving them a deal from Microsoft and I, know them and this and that. So I started doing it then. And very soon thereafter, I think in 93, I met Ron Conway.
Oh, yeah, sure. I know Ron, yeah. And his son Topher now, yeah.
Angel, and I invested in his first two funds.
And, so that's what got you. So you got into everything. I mean, so that got you into Google.
Yeah, and I still, he was in the Series A of Google, and then he distributed those shares in the IPO. And I still own some of those shares. My cost basis is like 50 cents on Google.
That's nuts, yeah.
Frankly, that experience, seeing how Ron worked and seeing the amazing compounding power of being in some of these transformative companies early, like Google, is what got me interested in investing more. And also, Ron was a lot of the inspiration of why 3 years ago I started Incisive Ventures, because I really wanted to help other people get the power of being in early in some of these transformative companies as a manager of.
Right. Yeah. So I think I must have met Ron as an entrepreneur, but when I had the Founders Club, which was the equity exchange fund, Ron wanted to he had about 200. I mean, you'd know this better than anybody, but I believe I sat down with him and he showed me this spreadsheet of every company he had invested in per fund. Yeah. And what we wanted to do was to say, everybody that was in there, each founder could put a little bit of equity into a limited partnership and be in a SV Angel Ron Conway equity exchange fund. So, because Ron, amazingly, there was not a single IPO from like 2006 when the window opened up again after the total .com nuclear winter.
Yep.
Anything that IPO'd, Ron was in it. Like it was somehow 100% coverage. Now that means he was in a lot of things that were running out of money and stuff. But I remember like Groupon, Pandora, you name it. He somehow got into them all. Back then. Yeah, I think Ron Conway's real mark on history is almost like the death of the angel group. That if you pitch a group of people and then they ask you to leave and they say something bad about you and you're not there to defend yourself, and that's like all these Amazon, Microsoft people and Tableau people, as opposed to like you just go and you pitch Ron and Topher, his son now, and it's like a one-on-one confidential thing, and he writes 3 checks a week, whether he needs a shower or not. He's doing that. Like he's deploying capital, and it happens a bit faster. And then
he was he was really great. I mean, he was walking around with a shotgun in the mid 90s in Silicon Valley, and you hit so many things like that.
Yeah. Well, it's also it's a matter. I mean, it sounds easy, but if you've spent all your time socializing and going out to 3 networking events a night and back-to-back 7 to 7 p.m. meetings,
it's not easy.
And you're up and down Palo Alto University Avenue, and you just meet 8 people, then using a shotgun is going to hit something.
Yeah.
If you walk out of Siberia, from Russia with love in a suitcase, or from China, good luck. Just,
you're not going to hit anything.
Implementing the Ron Conway playbook. But
right.
And so let's get over to Incisive. What does the word Incisive mean? Incisive Ventures. What is the thinking behind that?
Well, you could pronounce it the way you do. I pronounce it incisive.
Incisive. Oh, okay. Okay. Thanks for correcting me.
And incisive is thoughtful and diligent and thought-provoking. And the reason I came up with Incisive is I started Incisive Ventures in the pandemic, because when the pandemic happened in March of 2020, I was in Los Angeles running a company for a friend of mine that got closed by the pandemic. So I had to decide what I wanted to do. And one of the things I did is I said, let me look at how my investments have been going. And I, at the time, was an LP in 17 venture funds. I had done a couple hundred, about 150 at that time, investments, direct and angels. And I went and looked at all of them and where I was any good. And I tried to look what investments I had made on what thesis that could potentially be replicatable, and where did I just get lucky. And some of the investments were complete luck, but some of them were making thesis-driven bets, risk-adjusted bets. And one of those was like DocuSign and these other things. So I came up with.
And by the way, was that with Keith? Was that pre-Keith Kroc? Because I know Keith Kroc going way back to Ariba Software, and he became CEO. Like Benchmark, he was an EIR at Benchmark, so they put him in as CEO in DocuSign. And I remember early on, he goes, "Andrew, I'm going to crush this by going after real estate brokers. They want to sell that house, and the document back and forth in the scanner is crap. I'm going to get real estate agents, and then that'll be my Trojan horse to win the world."
This was before that, because the founder was a guy named Court Lorenzini.
Okay.
And I was actually, he was incubating the idea in an office space, and I was sitting next to him.
Oh, Jesus. Okay.
And Ignition led the Series A on that.
Okay, so Benchmark came in later?
Yes.
Okay.
Mm-hmm. So it was like at the idea phase.
Yeah. But
the idea there was, the idea of DocuSign was to it's a perfect example of my thesis for an investor, which is I invest in technology companies that reduce friction at scale. And so your technology invention has to take a particular workflow or business process and has to do it much more efficiently than the old way of doing it. And there has to be many, many people that have that particular problem or use that particular workflow. And if you think about document signatures, it's not, signing on the phone is better than a fax by 100%. And there's millions of signatures a day, so that fit that. The challenge with something like DocuSign, the challenge many times with these things is it a product or is it a company? And frankly, it was hard in the beginning to get DocuSign to get funded, and there was a very active argument at Ignition about that, because people said, well, hey, digital signatures, Adobe could write that in 5 minutes and add it to PDF.
That was the big concern I had with Keith. I said, give me $40,000 and some Ukrainian, Argentinian developers, and I'll have my competitor out there.
But what he did, and Court did it as well, and what was our recommendation from the Ignition guys, is we said, you need to make this into a platform. You need to build workflow around it. You need to do the custom integrations, like he said, into the tools that the real estate agents used and customize it for the real estate, get the workflow stuff and all the stuff around signing authority and moving signatures around and adding names and titles and dates and, all those other things. They were able to build enough workflow things around it to make it a platform and do enough integrations into particular businesses like real estate and others, that it was much more than just the digital signature itself. And when they were able to create a platform with the workflow stuff, that's when it became incredibly valuable. And certainly other people came along, HelloSign, EcoSign, but if you look at the enterprise value created by the first mover, DocuSign, relative to those other ones, it was like 100 or 200x more.
Yeah, I mean, I remember talking to Keith later about it, and I said, I think it's amazing that you somehow have this magical moat around what appears to be easy to replicate technology. And he said, well, we're a brand now. Like, if you think Gunderson and DLA and Oric are going to say, here's my HelloSign, I'm like, well, I use HelloSign, which is now Dropbox Sign. I'm too smart and too poor to overpay for things. But, Keith, to his credit, or you and Ignition and everybody really built a brand that, like, Hello's, these lawyers don't want to say, oh, use my cheap out of Australia
no, they don't.
Zoom. They're like, hey, I got a Zoom and I have a business card and I have an office. And I use DocuSign, but I think thematically, and I want to get into your meta themes, but for us, automating human workflows and then tapping into data sets. And when you automate a human workflow, but now you're tapping into data sets, that's like continuously doing that. It's cheaper than the cost of the human, or it's now cheaper than the cost of a team of humans. That data starts to give you that magic moat. That's not like a Keith Kroc, Ignition, brand that you convinced all the lawyers they got to overpay for DocuSign. But you've got a bunch of, what do you call them? Your 6 or your 7 meta themes? Your 7 meta themes. Do you want to talk about that?
So the meta themes, they came out of this process for 3 months during the pandemic. I looked at all my prior investments. Where was I any good? I came up with this idea of reducing friction at scale, and then I went into the details of what does that really mean in 7 themes. And I said, I'm going to try to replicate investments that are like that, and that's what I've been doing for the last 3 years with the AngelList Syndicate, and now my $10 million Incisive Ventures pre-seed fund. And those are the 65 investments that I've done. That's doing very well right now. But so those themes are. So
you're up to 65 investments in the 2-3 years?
In 3 years, I've done 65 investments. Yeah.
Okay.
Things that I look for once, in addition, and one of them is, could it be a platform? So this question of, is this a product or is this a company, and can it be a platform? If it can be a platform, like I believe DocuSign could be, your opportunity for a unicorn or an outsized return is, the probability goes up. Many ideas can't be a platform. Now, I don't only invest in things that could potentially be a platform, because there's very few platforms. Amazon's a platform, Microsoft has a platform, Adobe has, Google has a certain amount of platform, but where you can create one, that's one of the themes that I look for. The second, one is, can I be helpful? I only invest in areas where I think my network is a natural advantage, and I frankly encourage founders to do the same. Find investors who have accretive networks to what you're doing and understand the problem area. They don't have to be industry experts, but for example, that's one reason why I don't invest in crypto, I don't invest in biotech, I don't invest in consumer packaged goods, not because those deals may not be good companies, but because those networks and value don't align well with my own experience. And one of the themes is do anything that enables laziness. And a lot of people get a chuckle out of that, but it's kind of the other side of that, reducing friction. Most consumers want to be lazy. Like, why do we spend $3 for a Starbucks coffee when
or $6? I think I spent like $7 for a cup of coffee in a crunchy place in Austin.
Yeah, $7 for a cup of coffee when you could make it at home for 10 cents. because you're lazy. And there's something about the brand and the environment and whatever, but it's convenient. Americans are incredibly convenience oriented. So, you look at, what Amazon has done versus Walmart, one-click shipping, same day delivery, who bought this, bought that, reviews. It's all around reducing the friction and enabling people to be lazy. I can sit at home in my pajamas and order all my food and have it delivered to my door. I'm fundamentally, you're enabling my laziness.
Okay.
The same with DocuSign, right? Like I don't have to find a fax machine and print something out and scan and
paper
whatever.
jams. Pray the other guy can do it. Yeah.
Pray the other guy can do it. So that's kind of the other side of friction. But it is the consumers and business people, they fundamentally really, really want to be lazy.
Yeah. Okay. It's a good one.
Yeah. That's another one.
So within the meta themes, and you must have learned a lot. Like a number of LPs in my funds have gone on to raise their own funds. Like they thought that just getting our reports, coming to our events, meeting the founders, watching this worked out, this didn't work out, or all of our discussion and thinking. In being in like 14 plus funds, I knew you were in 10. That's a lot. What are your learnings from being an LP? That because and it's hard because you've got all this stuff going on from
well, the
DRM at Microsoft and working with all of the customers to being with Ron Conway and all those. But what are some learnings you had as an LP? And we can even talk about the returns that you got, because your returns are like 3x better than your LP returns. Isn't that right?
Exactly. That was one of the things that came out of this 3-month study I did of my investments in 2020, which is I was like, let me see how my LP interests are doing. And my LP interests were returning about 2.5, 2.6x, which is good, but it's kind of average.
Over what period of time, though? Like over what period of time is that happening?
That was over 15 years.
Right. So I believe I understand the stage at which you're investing in its and what we do. You do better than that just on MOIC. If you were selling into series B's and C's, you'd be outperforming that right there.
Yeah.
But I'll let you explain. So you did.
Well, but I mean, if you look at the Cambridge or the Preqin data, or this kind of pitch book, I mean, if you were an LP and you owned, an index of the venture ecosystem, you would hope to be doing about 2.5x over the life of the fund, right? Yeah. Then I looked at my angel investments, which were my direct investments, on this theme of reducing friction, and they were producing about 6.8x.
Right.
And so I said, I think those direct investments are better. I don't know exactly why. Is it because of the stage? Is it because of the fees of the fund or whatever it is? But let me go do more of those direct investments on this theme. That's why I decided to start investing and start Incisive Ventures, is because the data showed that when I invested directly versus through any venture fund, and I was in some top tier venture funds, Ron's fund and August Capital and all these more.
Howard Hartenbaum,
yeah, and all these guys. It's still, because of the larger law of large numbers, especially in multi-stage funds, you get average returns. And so I said, where can I get above average returns? Well, when you invest pre-seed, and that's maybe what we should talk about, the difference between pre-seed and multi-stage funds and stuff like that. You have the opportunity to get these higher returns because you're investing earlier, and you need a slightly different strategy. I mean, and I looked at this trying to replicate Ron's strategy, which was a shotgun. I actually, frankly, don't think the shotgun strategy is that good. I think you have to be, that's why I'm Incisive Ventures. I try to make a little bit more constrained decision on deploying the capital.
By the way, when Ron really had a moment of temporary lapse of reason when he said, standing offer any Y Combinator company, 150K uncapped note. So, he did this, not me. He said $150,000 on a safe note, which everybody hates, uncapped. Uncapped.
That kind of behavior.
And this is not
craziness.
If it's only his money, sure, do whatever you want, but that is just like, talk about laziness.
Yeah. Well, it was
not a
incredibly
great
easy
algorithm.
strategy for him, and he was creating an index, and I don't know how the returns worked out there, but that sort of behavior drove a lot of the non-incisive valuations and the bubble that we frankly just burst in November. When capital was free, investors didn't have to think that hard, and founders didn't have to try that hard. I'm actually very happy that we're back into a little bit more rational environment,
Of course,
where you need to be a little more incisive and a little more thoughtful about deploying your capital, because capital is limited. When you have limited capital, you have to make hard decisions about how to deploy that capital. When there's unlimited capital, you don't have to make hard decisions, and it basically allows for a certain amount of non-economic behavior, and that's how all bubbles are. And people benefit from bubbles, but bubbles also all burst because the irrationality and the numbers eventually come back to reason.
right.
And that's why I'm excited. Why I'm excited to be a pre-seed investor with a fund vintage of 2022 is I think the next 2 or 3 years are going to be some of the best times to deploy early stage capital in my lifetime. We made a lot of great investments at Ignition right after the dot-com bust, in 2002, 3, and 4. I made some great investments in 2009 and 10 after the crash. And I think that we're going to see a similar environment. And by the way, it's an even better environment, because if you look at the cost of operating and starting a company today relative to back then, we were talking about the cost of hardware. Who needs hardware now? You can plug into cloud services for almost anything you want to do.
Open source software, everything, talent.
Talent worldwide. Like
also talent was hard. Talent was
hard
in a bubble when Microsoft is giving children $350K starting salaries. Why should they work at a startup if you can get your student loans knocked out and become an angel investor on your AngelList syndicate? Like
exactly
that now, or the startup was raising 25 million on 125. And that same startup's raising 7 on 30. Yeah. And they're going to burn through 25 in 18, 24 months. They'll burn through 7 in 18, 24 months. So what does that mean? A bunch of people, talent available to work in the,
talent is much more available. Talent is much more available now. The exits are unclear, but I'm only doing pre-seed rounds that are 24 months of runway, and I'm hoping that in 24 months, we've got a more clear idea of the follow-on, and the IPO window reopens, and we get some amount of later stage traction and liquidity there. But you need to jump in longer rounds.
We do a little bit of pre-seed investing, but most of our entry point checks are into companies with 100K MRR. So they're already at 1.2. And then, I say on our homepage, like if we can't add value, we will not invest. That's one of our 7 meta themes too. But, and I think for reputation, if nothing else, that's a good rule to live by. Sure. But when we invest in good times, we said minimum runway 18 months if revenue is flat. So I'm not going to believe that you're going to outperform Cisco and Groupon with your year 3 hockey stick. Like we're saying, if revenue is flat, this is your monthly operating expense post financing and what it was. Does this financing, what we're in, give you 18 months minimum? When Putin invaded Ukraine, we said, all right, now that 18 is 24 months. Yep. So we're going for a 24-month cash runway, thinking a year from now we can say, how are we doing? And we've got 12 months cash in the bank to fire some people, to do a deal with the devil, to say, let's focus on customers. If that somehow was not already happening, like we've got a year to figure it out, and in the 18-month runway of a boom, you've got 6 months to figure it out. What often pushes us out of a seed deal, we've got a network, so we see good seed stuff, is that they're not raising for a 24-month runway. That their stock is so cheap at that stage that the founder has a much bigger risk appetite than like you and I do. And they've faced, they've looked death in the face at the abyss so many times that the fact that there's somebody writing a check for 500K and another one coming in for 250 and another one for $1 million, they're like, oh man, I'm not worried at all about a 12-month runway. And here's my sales pipeline that they believe in. How are you getting these founders into 24-month runways at the stage you're playing at?
Well, it's interesting that you said 24 months at seed. I'm saying 24 months at pre-seed. And the number one problem in the financing market overall today is this bid-ask difference between founders and VCs. I think most VCs have wanted to extend the runway. Most founders are pining for the good old days before November of last year when they could raise every 6 months with impunity on uncapped notes. And so we're still in that phase where some of them are trying to readjust to the reality. But the fact is that the smart ones are adjusting and doing the things that they need to do to keep their companies alive. Agreed. And I can't tell you how many deals I've passed on, because I just passed on one last week. It was a great team, Microsoft, Amazon, two great founders, AI and e-commerce, decent traction. They said, we want to raise 6 months runway.
Oh,
and I'm like,
yeah,
what the fuck are you going to do with 6 months
why?
runway?
So,
like,
so is there
because they were worried about dilution.
Right.
They're like, we think the valuation is going to be 5x in 6 months, so we're only going to raise a little bit at this little valuation, then we're going to raise a whole bunch more at a 5x valuation in 6 months. And I'm like, you must be seeing a completely different funding market than I'm seeing.
Yeah, I mean, that's a real example that they did not have their IPO pulled in, 2008.
No, they did not. They don't understand.
They didn't. Their muscles haven't memorized what yours did.
First-time founders, never been through a cycle, think that their pedigree and their brain is reason why people should just pour money on their head. And that's not going to happen. So there are still people out there, and that's the number one problem. I think you see it as well. Is bridging the bid-ask spread in a rapidly changing environment right now between founders and VCs. And in pre-seed, I'm telling many people are saying, 24 months is too long in pre-seed. You should have 12 months. But the problem I have, just like you, is that you're raising, with 12 months of runway left, whatever your runway is. And if you raise 12 months of runway, you're raising again. And so you're saying, I'm going to raise in 6 months. And frankly, 6 months from now, I believe we're going to be in a little bit of a recession, or something's going to be a little worse than it is today. Right. So I don't want to be raising in 6 months. I don't even want to be raising in 12 months. I want to be raising in 18 months.
I don't want our our founders should be socializing and developing their investor networks and taking an intro, showing up for a drink when you're in town and all that kind of stuff. But I want them to say, we've got some gas in the tank. We've got a thesis. We've got a tech. We've got a market. Let's prove it right or wrong. And let's see what we can achieve, some milestones. And then after we've achieved some milestones, then we raise again. And price this round to make sure it's a walk in the park, to have a pre-money that's higher than the post of this one.
Right. I mean, you say you get interested at 100,000 ARR, MRR. I get interested at 5 or 10,000 MRR. And what I'm trying to do is underwrite the product market fit and growth from that 100,000, from that 10,000 to the 100,000 when guys like you get interested. And so I need to put enough money into the company to give them enough time to get to that level. Now, we don't say that it's for another financing. I'm like, you have to get the traction level where the next round of people will be interested. And that's what we want to fund, is how long does it take to get to that traction level? And frankly, the other reason I'm going for a 24-month pre-seed is I think sales are going to take a little bit longer, and it's going to take a little bit longer to find your product market fit. So if the goal of pre-seed is to get to 50 or 100,000 MRR and you're at 5 now, if it takes even 3 or 4 more months, you need that much more runway, because the only way you get the next round done is if you hit the KPIs. If you run out of money and you're at 20 or 30,000, then you're doing a pre-seed extension, then you're on a bridge, then nobody cares, and you're in real trouble. So I want to be in a fully funded pre-seed round that has 2x the capital in it that we believe it's going to take to reach the next funding round milestones.
So make a budget and double it.
Make a budget, double it, and that's the round the size should be. And I don't participate in any pre-seed rounds that are step funded. Like he goes, we want to raise 1.2 million. We've got 200,000. Do you want to be the next $100,000 check? No.
Yeah, what I often think, my emotional reaction to a lot of these like unattractive approaches where they're saying, hey, this is uncapped, but you're getting 20% discount to the price round. I'm like, you know what? I'm happy to overpay by 20% when it'll be a 10,000% de-risking of value and milestone growth. Like you're saying you're going to take from this crazy point now and you're only rewarding us with a 20%. Sign me up for that priced round. I'm very happy to pay 20% more when it'll be 10x increase in value, in growth. So tell me about your screening process. Don't you have like a bit of a unique, or you've got your own kind of platform formalized thoughts around screening?
Yeah,
right?
I do. And I do have my own thing. So I get about 300 inbound and referred deals a month. Actually, more like 350. And I have some software that uses AI and algorithmic scoring and screens them against my meta themes. That's the other reason I have these meta themes is I can look for them in the data of a company. And so I have specific sectors that I look at. For example, I don't look at crypto. So if somebody chooses crypto in my forum, that goes into the no bucket pretty quickly. And the trick in getting 350 deals a month is that you can't even look at 350 decks. So I have some AI algorithm stuff that moves that down to about 60. And then out of that 60, I take about 20 meetings. But I've written some quite advanced software to try to screen that against my themes. And if you don't have themes, if you don't have sectors, it makes it a lot harder to screen the inbound. And then I have another tool. The tool that I'm most proud of is the fact that 78% of my pre-seed investments have received follow-on investing of a Series A. And that's about 2.5 times. PitchBook says your average pre-seed investor has about a 30% graduation rate from pre-seed to A, and I'm 78%. And part of the reason is because I'm an LP in a bunch of funds and I know a bunch of people. But another part of it is that I have some software that helps me map the universe and make introductions at scale a little bit more easily and figure out the right people to introduce these pre-seed founders to. And so I've invested quite a bit in making follow-on financing introductions, the value add that I specialize in. And many pre-seed investors don't do that. They're just writing checks and hoping, for the best into the best companies they find. But my thought on being a pre-seed investor is that you're never creating a profitable company in pre-seed. You're only creating a company that's going to raise follow-on financing. It's fundable, right? It's got product market fit and has got enough traction to attract a guy like you. And so if your primary objective is to be funded, then you should be good and have ways to add value to that next step.
Yeah, when we invest, whether it is one of our pre-seeds or it's that Goldilocks 100K MRR, sometimes entry point for us is the A round because I didn't like the terms on closing. Let's close on safes and stuff. Convertible notes, pre-money, post-money safes. Do you have strong opinions on those? Convertible notes, no governance on these notes. Right. What's the right thing for the industry?
It depends on the stage. I think you'll still see some form of converts in the pre-seed because basically it's hard to figure out a price in pre-seed. But what I'm seeing is a move away from safes, certainly uncapped safes, and more to convertible notes that are liabilities on the balance sheet. Convertible notes are better for investors because you have some rights. And I think you're going to see less safes done this year in pre-seed and more convertible notes. I'm also seeing seed rounds turning from safe notes into priced rounds. I think the seed and Series A's are certainly priced, but I'm seeing seeds becoming more priced now than in safe notes. And I think that's a good thing. I think clean cap tables are the ones that get funded. I just passed on a deal 2 weeks ago they had raised $9 million in safes at like 20 different fucking valuations.
Right.
And they were trying to raise 3 more before they did a $10 million Series A in a year. And I said, so you're going to have more safes than you're raising in your next round. Like, how do you think that's going to go? That safe overhang is crazy. And safes have been a very company-friendly thing, but it's frankly not a good idea to have too many safes. I don't recommend CEOs raise more than 25% on safes versus the next priced round that they
that's
want.
Triggering conversion. And I've heard some people argue that you qualify for QSBS if you're on a safe or a convertible note, but I don't think that there's any. You do not, right?
You do
so
not.
You're kind of screwing all the investors by the 5-year clock doesn't start ticking until that conversion happens. Also, how about do you guys use side letter agreements to say that I have a right to, or maybe double down is not part of your thesis?
We do have side letter for pro rata and everything, and frankly, we asked for it and we get it. Also, we found that many times the Series A guys make waiving those a requirement of their financing.
That's right. That's right. The really nice people at Sequoia don't want to see you exercise your pro rata.
Exactly. It's hard to maintain that, which gets back to, do you fundamentally have a good relationship with the CEO or not?
That is, right. And convince the CEO that he is the CEO and doesn't work for the next financer. All right. Well, listen, Martin, it's been great to talk to you. We could go for hours. Maybe we'll do it again in 6 months and catch up again. So look forward to seeing you in Seattle, or I guess you're going to be in Hawaii when I'm
going to be in Hawaii that time. So I'm glad some of my friends can come and be on your panel. I would love to catch up next time you're in Seattle.
Okay, we'll do it. All right, my friend. Thanks so much. Have a great day. Bye for now.
Take care, Andrew.
Well, that was certainly interesting. It's Mark DiTargiani with Pacific Western Bank back here. Again, really excited to be part of the podcast with 7BC and Andrew. And we're excited just to support the ecosystem and help you get to whatever your next step is in your business journey. Thank you very much.